Hello guys, in this video I'll be teaching you about developing a trading edge. By definition, an edge is a probabilistic advantage in the markets, such that over a certain number of trades, your overall results are positive. And the keyword here is a certain number of trades, so I didn't say one single trade. So that means you can lose, let's say, 5 to 10 trades, but by the time you are taking 15 or 20 trades, the difference between the winners versus the losers is still positive. So regardless of the number of trades taken, that advantage that allows you to lose some trades, win some trades, but still remain positive overall is what we call an edge. Now there are different ways to develop an edge, and once you understand this concept, you'll realize there is nothing like a special trading strategy, simply because you can develop an edge over almost any strategy and still be profitable. The most common way to develop an edge is combining a reasonable win rate with a reasonable risk to reward ratio, which I'll be breaking down in this video. Now, relying on a high win rate alone is very unrealistic, and this is where most traders get it wrong and fail. Just from the prop firm statistics, there's enough data to show that the most profitable traders have a very low win rate. So it's not always about having a high win rate. That's why it's important as a new trader to understand that the success in trading doesn't necessarily come from winning all the time, because you find many traders who are stuck around a point where they are trying so much to avoid losing. So anytime you lose, let's say 2 or 3 trades in a row, you start feeling like you're a bad trader. Let's say you finish 1 or 2 weeks negative, it affects you and you start imagining that maybe trading isn't working. But if you understand the concept of developing an edge, it's possible to have many negative days, but with just a few positive days, your results still become net positive. So don't focus alone on the high win rate. And by high win rate, I'm talking about the 70, 80, and 90% win rate. It is possible to have 2 or 3 months where you can have 70, 80, 90% win rate. You know, maybe the market conditions are very good and most of your trades are being respected. But over a long period of time, like 1, 2, 3 years, you'll hardly find a system which can maintain this extremely high win rate consistently. That's why anytime you're building a strategy, you need to understand that what creates an edge isn't necessarily a high win rate. Now my approach is try to find a balance between win rate and risk to reward, and I'll advise you try as much as possible to capitalize on the risk to reward ratio, because that alone is capable of turning a strategy from losing to winning, as long as you find the perfect combination of the risk to reward. So here's my guideline for developing a trading edge. The first thing is you need to find a strategy. Now when I say a strategy, again, most traders complicate what a strategy actually is. So you go on the internet and you're trying to learn so many complicated things. Now assuming you already understand all the basics of trading, you already understand things like candlesticks, support, resistance, liquidity in the market, the order flow of price, what moves prices from one level to the other. Assuming you already understand all these basic concepts, finding a strategy should be as simple as determining a criteria of things you must see before you consider a setup valid. And the question is, how do you find a strategy? Now most of the time before you find a strategy, it will involve a lot of practicing, a lot of backtesting, trying to combine different trading concepts on various time frames, and this might take a lot of time, and eventually there is a high chance you'll start to notice some patterns which keep repeating themselves in the market, and it's from these patterns that you can start deriving a setup. So you want to look back and see what are the common things, the common behaviors that happen anytime we have such type of setup. How does the market react most of the time? How many times does it react to your favor? How many times does it react against your favor? How many pips on average does it go to your direction before we have a significant retracement? Also, how many pips does it go opposite you first before it starts going to your favor? So it's from these things that you will define something called an entry criteria. And an entry criteria is basically what forms a strategy. So an entry criteria simply means you must see maybe 3, 4, or 5 things before you take a trade. In my case, for example, I've explained severally using my strategy. If I want to buy, I must see a demand level, which is usually a previous significant low. I wait for price to come at that demand level. I wait for a W pattern. It retests my neckline, and that's when I take a buy position. So what I just defined is my entry criteria, which basically forms my strategy. Part of developing the strategy is you must determine under what conditions or under what circumstances do you avoid trading in the markets. In my case, I don't take trades during bank holidays for the specific pairs that are affected. For instance, if you have a bank holiday in the United Kingdom, which means it will affect the volume of pound pairs, if I get a setup on any pound pair that I trade, I'll ignore them, however good the setup is. Because again, from my backtesting, I realized the pattern whereby on such days we have less volume because obviously the key players are not involved in the market. So the market might just do anything and easily disrespect my technical analysis. Now, once you've you've developed the entry criteria, the steps of the things you must see before taking either a buy or a sell trade, the next thing is to combine it with a reasonable risk to reward ratio. The whole idea of risk to reward is, in case you lose, you want to lose very little, but in case you win, you want to make 3, 4, 5, 6 times your normal loss. Now, in the process of backtesting, as you gather data, this is where you determine the best risk to reward. Now, depending on their strategy, the pairs or the instruments that you are trading, and the time frame, the risk to reward will vary. So for some people, they'll have a risk to reward of 1:1, 2, 3, 4, just depends. Some even have a risk to reward of more than 1:10. So if you want to be profitable, the least risk to reward that I recommend is 1:2. That's just the least. But of course, the higher the risk to reward, the better. Risk to reward is so powerful that it can create an edge for almost any strategy, regardless of the win rate. And I'll use my example. There are months where I do 65-70% win rate, but these are very rare months. There are also months where I just do about 40-50% win rate, but I still remain profitable because my edge is my risk to reward ratio, which is a 1:3. I'll give an example of the previous month of July. So in July, I had 8 losing trades and I had only 5 winners. But on the 8 losing trades, I only lost -1. On the 5 winners, I was gaining 3 times for each. So long story short, I won 15 minus 8, which leaves me with a reward of 7. To put this into context, if you're risking 1%, it simply means you finish your month with 7% gain. Considering the high failure rate of this industry and how difficult it is, if you can do 7% in a month, then you are definitely among the 5% in the industry. So despite losing more than I won, and the exact figure is I had a 38% win rate. Yeah, so a 38% win rate doesn't sound so good, but I still did 7%, not because of the win rate, but because of the risk to reward ratio. So that advantage that made me to be positive regardless of my win rate is what we call a trading edge. Assuming I was only doing a risk to reward of 1:2, for the 5 trades, I'll end up doing 5 times 2, which is only a reward of 10. But remember, I had 8 stop losses. So 10 minus 8, I now only remain with a reward of 2. Putting it into context with a 1% risk, this is equivalent to making 2% for the month. Now you can see the difference. With a 1:2, I'm doing 2% for the month. With a 1:3, I'm doing 7% for the month. So the win rate remains the same, but the only difference is the risk to reward ratio. Long story short, the only reason I am profitable some months is not because of my win rate. It's simply because of the risk to reward ratio, which is my trading edge. And someone might probably ask, why don't you do a risk to reward of 1:5? Why don't you do a risk to reward of 1:10 if it's that simple? But the thing is, depending on your strategy, the time frame that you are using, it's not always realistic to find these crazy risk to rewards of 1:5, 1:10, 1:15. I mean, once in a while you might find them, but the chances of finding these crazy risk to rewards consistently is very low. So if you have a system that you can backtest and get a 1:5, 1:6 plus, then you are lucky and that's good for you. But for me, I only do a 1:3 and I'm still extremely profitable, so I can't complain. So by now you understand what I meant by combining a reasonable win rate with a reasonable risk to reward to form a trading edge, and not necessarily relying on just one of them. When you understand this concept, you will realize that almost any strategy can work as long as you can crack the optimal risk to reward ratio that gives it an edge. This is why experienced traders don't necessarily criticize how others approach the market, because someone might be using what you consider a very weird trading strategy, but they have mastered the type of setup and they have a very high risk to reward ratio. So they can be trading using trend lines, which some people consider don't work. I used to be one of those people, but over time you realize it's not about the trend line. It's about mastering a very specific type of setup, which you can spot in the market happening over and over again, and capitalizing on the risk to reward ratio. In my growth as a trader, I've come to accept that it's not strategy that makes you profitable. It's actually understanding how to combine strategy with risk to reward ratio. In fact, for me, I'd argue that strategy is only helpful to finding the entry. That's why I call it an entry criteria. But once I've found that entry setup, what makes me money is losing less and making significantly more per trade. Now you might wonder, why do you need this information about an edge? So I'll ask you a question. What happens if today, for some reason, your trading strategy stops working? Does it mean you stop being a trader? So you've invested 3-4 years into learning a strategy and then it stops working. So about 1.5 years ago, myself, I couldn't answer that question. So I used to trade imagining that for some reason my strategy should always work. And if something were to happen in future and my strategy stopped working, then I'd really struggle. But right now, I can easily move from my strategy and apply a new trading strategy as long as I find the edge around that strategy, of which it will definitely take time. I'm not saying you can switch strategies within a day or a week, because you'll have to spend time trying to understand the new strategy, the type of setups, backtesting more. You'll make a few mistakes, but eventually you'll still develop an edge around it and be profitable, which is the goal. And lastly, after sharing this information, then becoming profitable seems like it's very easy, right? It's just a matter of finding an entry criteria and trying to lose less and win more. But if it's this easy, why is it that many people are still failing? So the answer is, when most traders are trying to implement an edge, they lack something called discipline. And this is where trading psychology comes in. For instance, you can have a profitable system, but your profitability is simply dependent on the fact that you have a risk to reward ratio of 1:3. Then you go to the markets, the emotions kick in. When your trade is running at a 1:1 or a 1:2, you end up closing prematurely. Now this alone, if you remember the example that I shared with you, can turn your performance from doing 7% to a whole 2%. The same way it can take your performance to break even or even negative. So yes, you can have a very good strategy, a very perfect risk to reward ratio, and an overall profitable edge, but you as the trader become the problem in implementing that edge. So when you backtest your strategy, you find that maybe last month you made 7% according to the strategy, but on your account, the results are only reflecting a 1%. So where is the gap? It is you as the trader who was the main problem. I've previously shared some trades which I had to hold for a long period of time, even though they were frustrating, just to hit my risk to reward ratio of 1:3. And while some traders commend me for having good psychology and the stability to just hold the trade for that long, I often get the question, how do you manage to do it? So it's very simple. I have a perfect understanding of my system, and I can clearly say that most of the time, my edge or my advantage in the market is purely based on me taking the risk to reward of 1:3. So the fact that I've already understood that if I just move from 1:3 to, let's say, a 1:1 or a 1:1.5, my results can quickly switch to negative. So when you see me holding my trades to 1:3, it's not that I don't have the emotion, it's just that I don't have a choice. Because if I become indisciplined to the plan and to the system, then I won't be a profitable trader anymore. And that brings me to the end of this video. If it helps you, be sure to give a thumbs up and subscribe for more trading content.